could go to $500 silver, we could crash all the way back down to $100 or even $50 silver. And then potentially we could start a third phase of the bull market that could take gold to 30, 40, 50,000 during that third phase. People have a tendency towards recency bias, and they're going to assume that since this suppression worked, that the next one's going to work, and they're going to be gun shy, and that's going to mean that people are going to sell way too early. They'll want to sell at $150 silver, $175 silver, and they'll miss the move to 500. Some of it was just sentiment got too bullish, and some of it was the banks needed to bail out, get out of those short positions. So if our final target naturally would have been $250 silver, this probably guarantees the shortages are going to be worse. And I think gold probably has a double from here once we break out. So I think our top was close to 5,600. I think we're probably going to double during the last final parabolic bubble phase of this bull market. We start the next leg up and we break out above 5,600. I think we're probably going to at least double. I think 10,000, it's going to be an easy ride to get there. It's a very mature bull market, and we've started to go parabolic. There's usually a correction in the middle of that parabolic phase, especially for silver. There's a decent chance that this is that correction. It's volatile, it's scary. People become convinced that the bull market's over, and it ends up being a huge bear trap. And then you get a bottom, and then the next leg up ends up being as good, or in this case, I think multiples better than the first leg of the parabolic move. So the last 2 months have been, amazing for, especially if you were leveraged. You made life-changing gains during this last 2 months. Your complacency is going to get washed out here, and a lot of people are going to, assume that the bull market is over. And then they're going to get stuck on the sidelines when the second phase of the parabolic move starts. And the second phase, I think, will be several times bigger than what we just went through over the last 2 months.
The most dangerous moment in a bull market is often the correction that convinces investors the trend is finished. As Gary Savage suggests here, parabolic phases historically include sharp shakeouts. Silver dropped nearly 35% during the 2011 run before doubling again. Markets often remove leverage and emotional buyers before advancing further, especially when sentiment indicators spike above 80% bullish readings. This kind of volatility typically reflects liquidity repositioning rather than trend reversal. Long-term investors should focus on cycle structure, not daily price swings. And what Gary Savage explains next reframes why corrections often precede the strongest advances.
So we went from 50 to 120. I think the next leg, when we're ready to break out above that 120, could take us to, it's easily going to take us to 250. I mean, that's only 100%. That's easy during a parabolic move. That's almost standard during a parabolic move. But for metals that are much more volatile, I think there's a very, very good chance at this point that we could go from 120 to 500. So I think the next leg is going to be a lot bigger than this first leg. And you think you made a lot of money during the first leg? You haven't seen anything yet.
Well, and hopefully people are still in and waiting for that last part of the parabolic move. Maybe you can help me understand a little bit more where you see us in the cycle for gold and silver, because it is a little bit different from everybody who's saying that this is just beginning. So this was perhaps the first parabolic move, then there's a second, and after that, is that the end of the bull market for gold and silver in your view?
Maybe.
Percentage projections sound dramatic, but parabolic math is common in late cycle commodities. Gary Savage often notes that during the 1979 to 1980 silver run, prices rose over 400% in less than 12 months. A move from 120 to 250 is actually consistent with historical blow-off patterns rather than extraordinary forecasting. The real question investors should ask is whether liquidity conditions, interest rates, dollar strength, and institutional positioning support such expansion. The Fed's rate path in 2026 may matter more than price targets themselves. Next, Gary Savage outlines how commodity cycles historically unfold in phases investors often misread.
And I'll qualify that. Generally, these commodity bull markets, they unfold in two phases. So the first phase of the bull market was from 2001. Well, it double bottomed. So you could say either 99 or 2001, double bottomed, gold did at 255. So let's say you pick 2001. That's where the bull market started. The first phase ended at that top in 2011. But that wasn't the end of the secular long-term bull market. That was the end of the first phase of the bull market. And then we had a cyclical bear market, fairly short. What was it, about 4 years? It ended in the fall of 2015. And at that point, we started the second phase of the long-term secular bull market. So this phase, the second phase, is getting pretty mature. Started in 2015. We're in 2026, so we're getting close to 11 years at this point. And we've started to go parabolic.
Investors often confuse cyclical corrections with the end of secular trends. Gary Savage highlights that gold rose roughly 650% from 2001 to 2011 before entering a 4-year decline of about 45%. That correction reset valuations, mining costs, and investor positioning without ending the long-term trend. Since the 2015 bottom, gold has again climbed steadily, supported by central bank purchases and rising sovereign debt levels. Understanding cycle duration helps investors avoid panic selling near late-stage accelerations. And Gary Savage next explains why parabolic behavior usually appears near the end of long commodity cycles.
Gold, when they failed to keep the suppression at 2000, you can see what happened if you pull up a long-term chart. The character of the market changed. That was because the banks were caught in a short squeeze in the gold market. Eventually that kind of bled over into the mining stocks. They had big moves. Silver was the last to break the suppression. I thought it was completely broken, but I guess they still got a little bit of firepower here because that was the second part of why this correction is happening. Some of it is we just got, way too bullish, ran out of buyers. We were due for some kind of correction anyway. And I think the banks took advantage of that and coordinated a huge overnight attack that dropped silver, whatever it was. I think it was almost 30%, or maybe it was 30% almost overnight. That allowed them to get out of their shorts because a lot of those contracts were going to stand for delivery, and they were going to have to buy physical silver at $120 an ounce to deliver.
Short squeezes rarely appear in headlines, but they often reshape entire commodity trends. Gary Savage points to moments when futures positioning becomes extreme, like the COMEX short exposure spikes seen during past metal rallies. A 30% overnight drop suggests liquidity intervention or forced unwinding rather than normal price discovery. Mining stocks historically amplify these shifts, often moving 2 to 3 times the underlying metal. Investors should remember that futures markets can temporarily distort physical supply signals. Next, Gary Savage connects this correction to how shortages may actually intensify later in the cycle.
So I think some of it was just sentiment got too bullish, and some of it was the banks needed to bail out, get out of those short positions. So I think that's probably what's happening, but it's not going to hold any more than any of the other corrections held. It's just going to make the shortages even more extreme, which just means that price is going to go even higher during this final phase. So, if our final target naturally would have been $250 silver, this probably guarantees the shortages are going to be worse, and that the odds are more likely now that it's going to get to $500.
I want to ask you a little bit more about the silver suppression angle as well, because I remember last time we spoke, you'd mentioned it's a market where that suppression has been able to hang on longer than it has in other places. So are we at this point entering the last gasps of that? Is it coming to an end at this point?
When corrections are blamed on sentiment alone, it often hides structural stress in futures positioning. Gary Savage highlights how short covering can temporarily suppress prices, but physical demand trends usually reassert themselves. Global silver deficits have averaged roughly 200 million ounces annually since 2021. If shortages truly worsen, price volatility could accelerate rather than stabilize. Investors should remember that commodity markets often tighten just as confidence falls, not when optimism peaks. That dynamic can reshape portfolio allocation decisions quickly. Next, Gary Savage explains why investor psychology during corrections can determine who benefits from the final rally phase.
I tend to think this will probably be the last one. Now, they've tried multiple times during this last 2 months to stop this rally. And every time they did, the buyers would come in and just kick them in the teeth, and they'd lose more millions of dollars. But we've reached a point where sentiment was extreme enough that we were, going to run out of buyers. And I think they just jumped on the opportunity and slammed it in the middle of the night and slammed it hard enough to where it went down to where people really started to panic and sell. And they were going to be profit taking anyway. But I think people have a tendency towards recency bias, and they're going to assume that since this suppression worked, that the next one's going to work, and they're going to be gun shy. And that's going to mean that people are going to sell way too early during that final parabolic move. That they'll want to sell at $150 silver, $175 silver, and they'll miss the move to 500. So don't let this get lodged in the back of your brain that you've got to, that the cartel is going to attack again and that you got to get out early, because I think you're going to miss those once in a lifetime opportunity. That's the next phase. I think is going to go much further than most people expect. Really, I think you don't really want to sell until that gold silver ratio gets down to at least 25-1, and we may go as low as 15-1.
Recency bias often causes investors to mistake temporary volatility for structural trend changes. Gary Savage points out that extreme sentiment readings frequently appear near intermediate corrections, similar to commodity pullbacks seen in 2006 and 2010. When silver sentiment peaks above historical norms, liquidity-driven sell-offs can follow even while long-term demand remains intact. The gold-silver ratio falling toward 25-1 would historically signal late-cycle commodity strength, not weakness. Portfolio discipline matters more than reacting emotionally to sudden price moves. Next, Gary Savage connects ratio analysis to long-term exit strategy decisions investors rarely plan ahead.
Where does that place the gold price in your mind then?
I think gold probably has a double from here once we break out. So I think our top was close to 5,600. I think maybe it even tagged 5,600. I think we're probably going to double during the last final parabolic bubble phase of this bull market. So once this is over with, the correction, we start the next leg up and we break out above 5,600. I think we're probably going to at least double from there. So I think 10,000 is almost, I'm going to say it's a piece of cake. Doesn't mean it's going to be an easy ride to get there, but I think it's going to be a piece of cake. And we might even get to 11 or 1,200. And now the other part of your question, I almost forgot. The other part of your question is this over when this parabolic move tops? Generally, I would say yes, although it might be that we just have a cyclical bear market. So let's say we get a parabolic top later this year or maybe early next year, and then we get a cyclical bear market, the same thing that happened from the 2011 top to that 2015 bottom. That was not a secular long-term bear market that lasted 15 or 20 years like the one from 1980 to 2000. It was just a cyclical bear market.
Price targets grab attention, but cycle timing matters more than headline numbers. Gary Savage references the possibility of gold doubling, yet history shows parabolic peaks often coincide with tightening liquidity conditions, similar to the 2011 commodity peak during the Fed's post-crisis normalization phase. Gold rose about 700% between 2001 and 2011 before entering a multi-year decline. Investors should think about capital preservation planning during late cycle rallies, not just upside projections. Cyclical bear markets can erase gains quickly if leverage remains high. Next, Gary Savage discusses how future cycle lows could shape the next decade of commodity investing.
It is very possible that might be what we would have this time, is just a cyclical bear market that lasts Well, the next 8-year cycle low is going to be due in 2030. So maybe it's only a 3-year cyclical bear market, and then we end up having a third phase to this long-term bull market. I am open to the possibility of that, but keep in mind these parabolic moves, they tend to crash. So we could go to $500 silver, we could crash all the way back down to $100 or even $50 silver, and then potentially we could start a third phase of the bull market that could take gold to 30, 40, 50,000 during that third phase. So it's possible. I'm open to the possibility.
Well, and just to get an idea of your process, so there's all of these different possibilities that could unfold. So you're constantly evaluating and reevaluating what you see in the charts to figure out what direction we're actually going to go in.
Yeah, you have to be willing to change directions, and you can have your expectation, but if the market tells you that your expectation is not going to play out, well, then you have to adapt.
Parabolic rallies rarely end with stability. They typically end with volatility that reshapes investor expectations. Gary Savage emphasizes cycle flexibility, which reflects how commodities behaved after the 1980 and 2011 peaks. Silver lost more than 70% after its 1980 spike, yet long-term monetary trends later revived interest in precious metals. The mention of a potential 2030 cycle low aligns with broader macro cycles tied to debt expansion and monetary policy shifts. Investors who adapt to cycles rather than narratives tend to preserve capital longer. And Gary Savage next turns toward how long-term positioning decisions influence investor outcomes during these transitions.
Longer term, I don't see any need to adapt. I think we're still in a bull market. The gold-silver ratio has not gone below 30-1 yet, and I expect that this attack by the cartel probably means it's going to go to 20 or even 15-1 before we get our final bull market top. So there's no need to adapt any of your long-term expectations at this point. Short-term, maybe. This may turn out to be an intermediate degree correction rather than just a minor daily cycle correction. Again, it's not going to change the long-term outcome. It just means that the correction may last a little longer than first anticipated. My anticipation was that this was going to be a daily cycle correction and would be over, 8 to 10, 12 days, and then we'd start the next leg up. And that may still be possible. We just have to see what happens to gold here tomorrow and next week. If gold breaks back above that 10-day moving average, then we probably got our bottom here a couple days ago, and this is just a minor daily cycle correction.
When investors focus on price forecasts but ignore ratios, they miss the real signal driving cycle timing. As Gary Savage often emphasizes, ratio analysis historically identifies late-stage commodity rallies more reliably than price targets alone. The gold-silver ratio staying above 30 suggests liquidity conditions haven't reached speculative extremes yet, similar to mid-cycle behavior seen in 2006 before metals surged again. The 10-day moving average test mentioned here reflects short-term momentum confirmation traders watch after corrections. For portfolio investors, this means volatility doesn't equal trend reversal, and as he suggests, the ratio behavior in the next move could reveal whether this rally is entering its final stage.
We'll go up, maybe hit 6,000. Then we'll get that longer term intermediate degree correction, something that lasts 4 to 6 weeks maybe. Otherwise, if this continues a little longer, then this turns into that intermediate correction. And so, just arrived a little sooner than I was anticipating, but it was going to happen anyway. And it's not going to change the long-term view. So it's nothing to panic about.
Well, maybe I ask you a little bit more about your exit strategy when it comes to gold and silver, because already when we got to the triple digit level for silver, I know a lot of people said, all right, we got to $100. This is time for me to take at least some profits. So how are you approaching it? Are you just holding until we get to those higher levels that you see coming?
Well, I'm not going to sell any of my physical until I see that gold to silver ratio, at least at this point, probably at least 25-1. So at that point, I would probably sell 75% of my my physical gold and silver holdings, hang on to the last 25%, see how much further, maybe it can get down to 15 to 1.
Price milestones like $100 silver feel decisive emotionally, but ratios often matter more than round numbers. Gary Savage has repeatedly noted that emotional profit-taking typically happens too early in commodity cycles. Historically, during the 2011 metals peak, retail investors sold into strength months before the final spike, missing large gains. Waiting for a gold-silver ratio near 25 to 1 reflects cycle-based discipline rather than price-based reaction. For investors, this reinforces the difference between trading excitement and managing long-term allocation risk. Next, his ratio-based exit logic becomes even more important when leverage enters the picture.
I would sell all leverage if we get, and even if we get below 30 to 1, I would probably sell at least 50% of my leveraged trades, probably 75% of my leveraged trades, and maybe just go completely unleveraged in my trading account. Now, the physical is a much bigger position for us. My recommendation, and pretty strict recommendation, is 80% physical. Physical that's your insurance. We can trade that other 20% in leverage. We always err on the side of caution. So like if we're trading options, we're always going to buy a ton of time just in case we get caught. Like if this were to turn out to be an intermediate correction that's going to take several more weeks, we need a lot of time on those options. That's exactly what we did. We bought a ton of time just in case we get caught. So that's our protection for our leverage, but also our leverage positions are just much, much smaller than our physical position. And I expect over the long haul, we're probably going to make a lot more money in our physical position, our quote unquote get rich slow position.
The real lesson here isn't about silver. It's about risk hierarchy inside a portfolio. Gary Savage consistently reminds investors that leverage amplifies timing mistakes more than it amplifies returns. Data shows that during the 2020 gold correction, leverage mining ETFs fell over 60%, while physical gold dropped less than 15%. The 80% physical, 20% leverage approach mirrors institutional risk management models used in commodity funds. For long-term investors, insurance assets exist to survive volatility, not outperform speculation. And as he warns, leverage discipline often determines who survives the final correction.
The leverages are get rich fast position, but sometimes the leverages are very painful position if you get caught and have to hang on for a few weeks while we work through a correction. So those positions are much smaller than our physical position.
So it's more, when you're deciding when to sell, it's more about the ratio than about the price.
That's how I'm going to judge that we're getting close to that top, is that ratio. And we may also get a Dow gold ratio that's maybe down to 3 or 4 to 1. That would be something else I would look at. So there's no real specific price that I'm absolutely going to take profits at that point. If silver's at $250, but the silver gold ratio is only at 40, well, I'm going to keep holding. If the Dow gold ratio is 15 to 1, I'm going to keep holding. So yeah, I'm not going to pick a set price where I'm going to buy. I'm going to be watching probably those two ratios would be. And then also another thing to watch for is just kind of pay attention to what's happening around you.
Markets rarely top on price alone. They top on relative value extremes across asset classes. Gary Savage often points to the Dow to gold ratio as a macro sentiment indicator during cycle transitions. In 1980, that ratio fell near 1 to 1 during peak commodity panic, while in 1999, it exceeded 40 to 1 during the tech bubble. Watching intermarket ratios instead of headlines helps investors avoid selling too early in inflation-driven cycles. This framework shifts focus from prediction to confirmation. He believes those cross-asset ratios will quietly signal when the metal cycle is truly ending.
If your neighbor is bragging about how much money he's making in gold and silver, or the people you work with that know nothing about gold and silver are bragging about, they're getting rich in gold and silver, that's a bell ringing that you're pretty close to the top. We saw that during the housing bubble. You saw it during the tech bubble. People doing irrational things, people that had no idea what they're doing. They just know that their neighbor's getting rich and they want to get rich. So that's something else to look for. Look at, pay attention to those two ratios, and then pay attention to what's happening in the public. If a lot of people that, have no idea what they're doing are starting to brag about getting rich in gold and silver, maybe time to dance close to the door before that last chair gets pulled away.
Yeah, I think that makes a lot of sense. And I wonder, just as we're talking about the physical metals, do you think we reach a time where it becomes hard for people to actually get their hands on the physical metal?
I do suspect we're going to see some shortages at the bullion dealers when we get close to the top, just because there'll be so much retail buying. And I've got some inside connections with some of the bullion dealers, and during this smash, their buying was 2 and 3 times higher than any other time in history. So a lot of people are seeing this for what it is. If you want to buy physical, the banking cartel gave you an unbelievable gift. Use this to load up on your physical.
The loudest bullish signal in any market often appears right before the cycle breaks. Gary Savage frequently warns that public participation spikes near major tops, not at bottoms. During the 2007 housing peak and the 1999 tech bubble, retail inflows surged just months before collapse, according to Federal Reserve flow of funds data. Reports of bullion dealer demand jumping 2 to 3 times higher than any other time resemble late cycle behavior rather than early accumulation. Investors should recognize sentiment extremes as risk signals, not validation.